Okay, hi everyone. Welcome to Endeavour's South Africa's second Virtual Connect, titled Raising Cash, Capital During Crisis. I'm Marc, Herson, an investor and coach. I'm fortunate enough to coach several of the Endeavour entrepreneurs, which is an incredible organization. For those of you that don't know, Endeavour is a global organization headquartered in New York, located with presence across 34 markets or so, and really with the mission of promoting economic growth, job creation through supporting high impact entrepreneurs and helping them to scale rapidly. In South Africa, Endeavour is an incredible organization headed by Alison Collier, and we currently have 27 portfolio companies. On average, they generated 200 million rands worth of revenue per annum the last couple of years, ranging from 40 million per annum to 1 billion rand or so, and seeing some sort of growth, great growth, approximately 27% annual growth and in revenues and around 29% growth in headcount. I'm very excited today to have a fantastic panel from mostly located in South Africa, but we also have Rob, who's located on the West Coast in the US. And let me take you through the panel and then we'll get to asking some questions. There is a Q&A box which is active at the bottom of the Zoom box. And please feel free to ask questions and we'll try and get to them towards the end of the session. I know we sort of said it's going to be an hour and a half, but we're really targeting an hour. So please stay with us, please ask questions, get involved. So I'll start with just introducing the panelists. We have Louise Stuart, who is an executive at Naspers focused on M&A and the Naspers Foundry, which is the 1.4 billion rand that's been set aside by Naspers to invest in South African startups. We have Melvyn Lubega, who's a founder and director at Go1, an edtech company which recently raised $40 million from the likes of Microsoft Ventures, Salesforce Ventures, and more. And then we have Benji Meltzer, who's the co-founder and CTO at Aerobotics, an agri-tech and AI company, which recently raised 100 million rand from Naspers. And then lastly, Rob Eloff, who's a co-founder and managing partner at Lateral Capital, a VC fund based in New York, focused on investing in foundational technology across Africa. Rob, I'll start with you. Tell us a little bit more about Lateral Capital, a few of your notable investments. What are you seeing in the VC landscape across Africa now? How does that compare to the rest of the world? And how do you see the next 12 months unfold there?
Thanks, Marc, and thanks to Endeavour for putting this together. I think, if we take a quick step back to what the VC landscape looked like 12 months ago, it's clear that the VC landscape in Africa is fast evolving. And depending on, whose data you use, African VC funding increased by between 5 and 8x, over the last 5 years, with meaningful participation from Europe, US, China, and Africa domiciled funds. Lateral Capital is a venture fund that makes equity and debt investments in companies that are solving foundational technology problems across the African continent. Lateral came about quite organically, in that it's the result of a number of years of angel investing alongside my partner, Stephen, and a handful of family officers who were open to the idea that, Africa might need an alternative model for funding, high growth companies than traditional venture capital or private equity. And so we built something that we thought could meet the market where, we thought the need was. And that really means two things. It means firstly, the ability to invest across the capital structure, so equity and debt. And secondly, the ability to act as a lifecycle financing partner for founders that are, profitably solving for essential products and services. So, that means being able to invest from seed plus stage through beyond Series B. We announced our first close earlier this year, and we've launched an institutional venture fund alongside our family office platform to scale up what we've built to a $50 million cross-asset venture fund. And yeah, we've made 13 investments to date. We're a team of 8 spread out between Kenya, Nigeria, Tunisia. We have a presence in Johannesburg as well, and the US. And I think, to really sort of focus on the core thesis, foundational technology for us is essential products and services. It's typically not consumer-facing, discretionary spend categories. We're really focused on verticals that are essential to, prosperity of the continent, but, where we see valuable companies being built in these large markets. And that for us has meant fintech, human capital verticals like healthcare and education, and clean technology. And just to mention a couple of notable investments that I'm really excited about. We invested in a company called SparkMeter, which is not only pan-African, but a pan-emerging markets clean tech smart metering company that uses radio mesh networks to monitor and manage central and rural microgrids. This, is a market-leading technology and a team that spun out of one of the leading schools here in the US, and now has products in 22 emerging markets under, still a very visionary team and a strong cap table. Just to mention another one, we're really excited about our investment in AppZone Group in West Africa, which powers the banking sector, and really is building a digital operating system for commercial banks, any African bank really. And then lastly, we recently made an investment into an enterprise SaaS business called Seamless HR, which is also Lagos-based and is really building the Workday or Zenefits for the African market, and then also going on to service SMEs. So that's a couple of broad brushstrokes. I'll pause there, and happy to sort of go more into the current VC landscape and how it's changing.
Take us through. Thanks for that. Take us through, how do you, the VC landscape, how you see it, how it's changing. Yeah, that would be great.
Sure. So look, let's get straight to the point. I think clearly there is currently a lot of uncertainty and I think a lack of real bottom-up data resulting from this pandemic. And I think it has probably decreased, it has definitely decreased the risk appetite for developing markets as an asset class. If you're a capital allocator sitting in a financial capital in the world, that has sort of probably gone down your priority list. That said, there are very definitely investors that recognize that there'll be tremendous opportunities to partner with founders that are building enduring businesses. And, for context, in the past 3 months, we've followed on to one of our portfolio companies and we've made 3 new investments, all of which closed during COVID. And so I think if you as an investor are in a position to be making investments over the next 2 to 3 years, and you've built deep relationships with founders that have market-leading technology and that have tenacity and agility, this is an incredibly exciting time. And, I think it's also really important to put the African VC landscape in a global context. I read an article recently that 40% of UK startups don't have 12 months of runway, and 70% of Dubai-based companies potentially will go out of business. And so I think it's important to separate, early stage companies and venture capital generally, which I think people would agree became, quite bloated and ill-disciplined, especially in the US the last 5 years, from technology-driven businesses in Africa, which tend to prioritize profitability by necessity, alongside growth. And I think it's really important to remind everyone that we're facing the largest, most urgent digitization in the history of our species. It's maybe a little bit oversimplistic to sort of revisit what happened in China in 2002 during SARS, because Africa is very different. but we like to remind ourselves every day that, you know, Alibaba, I think, had $10 million of cash in the bank, and, you know, was spending $2 million a month in burn. And things happened with that digitization. And so I think we do see a huge catalytic effect coming from this. A lot has changed, and, you know, the next 12 months will look different. And I think the most important thing is to have a very transparent and data-driven relationship with founders around how things are going. We put a lot of emphasis on sort of KPI monitoring and focusing on solving problems as they arise. And I think those conversations have gone from monthly to weekly or sometimes daily with our 13 portfolio companies. So, you know, just to summarize that, I think the shift to digital and having a deep understanding of sort of the venture ecosystems in African markets, whether that's Cape Town or Lagos or Nairobi or Cairo, this is going to change things a lot. But we're incredibly excited, and I think it's about discipline and transparency.
So just very, if you can, in one or two sentences, what will you be looking for? You know, what are the you know, the key verticals that you'll be looking for, and what, you know, which are the ones that definitely won't be on your radar now?
Sure. You know, so as I mentioned, we invest in we have non-dilutive financing, so debt and equity. And I think before COVID happened, we were quite intrigued by the number of our portfolio companies doing business with each other, using each other's products and services, especially in East Africa. You know, with our Nairobi-based portfolio companies, I think it was nearly 60% of our Kenyan companies were using each other's products and services. And so, you know, we've been thinking very deeply about technology solutions that create multiplier effects for other startups, and that really provide platforms that both, if you focus on fintech, for example, fintechs and banks and mobile money operators can use, you know, ubiquitous technology layers and platforms to finally scale. The big challenge has been getting to a second and third market. And so I think practically what that means is we're very excited about sort of the API economy. And there's some really exciting companies in South Africa and across the continent that have built unified API solutions for that group of customers. I think we're also very focused on secondaries and very early stage M&A. We're already talking to companies that would be open to combining with the second and third mover in their markets to achieve scale. So I think there's going to be an element of hands-on deal making at that stage. And then lastly, I think the most ignored sector on the continent, which, you know, Benji's probably the best position to comment on, is technology applications for agriculture. You know, it's one of our greatest assets on the continent, and I think it's very misunderstood, and venture typically says, well, that's real assets and we don't really understand that. But we're very focused on that as well.
Cool. Melvyn, you've benefited, or Go1's benefited in a way, it seems, from the pandemic. You know, the last couple of months, you've managed to close your $40 million round. Can you maybe just, you know, in a sentence or two, tell us a little bit about Go1, and then you know, tell us what it was like to raise the round, you know, during COVID. What did you learn? You know, what needed to change?
Yeah, and I was really hoping that Rob was going to do a shout out to education and edtech in his preferential industries, but nevertheless. So particularly what we offer at Go1 is essentially the simplest interface for an organization to find the right training for their staff, to duplicate and bring everyone around. So we essentially offer as our learning solution, as well as probably the world's largest online corporate training library. It brings together hundreds of thousands of courses into one library. So think of it like a Netflix for corporate training, and we offer that as a B2B subscription service. And, you know, it's interesting when you reflect on, I think, how does finance a business? And I think it's good that Rob spoke to, you know, being holistic and thinking beyond just, let's say, pure equity financing and also debt financing, because it's important that not all businesses should take on venture financing, or venture financing in a particular way. And so for us, our journey was in December, our board meeting, taking to the board that, look, we've tested our various go-to-market strategies. We're seeing phenomenal growth over the last year, and we want to pour more fuel on the fire in terms of our impact. And so it was a decision around saying, this is the path we want to take, and this is how we want to use the money. And I think the important thing for us was, as founders in the business, having a clear sense of what we actually want to do with the money and how that would take the business to the next level and grow the valuation and our client value in that particular way. And so really at that level began engaging investors in mid-Jan, early February. So fortunately ahead of what would be the COVID situation. And so it's interesting, I guess, to get some thoughts from the investors on the webinar as well, how they think about new companies into their funnels now, as opposed to deals that were already in the pipeline before they actually, COVID was properly announced to the world. And so for us, it was interesting whereby we had some strong investors on our cap table, but we were very clear on the kind of investor we wanted to lead the round, given our longer term ambitions in terms of the global enterprise ecosystem. And so we were very fortunate that we're able to leverage existing networks within our board and other areas to try and get introductions to a short list of particular core investors you want to work with. And I think it's very important. You think about fundraising in COVID versus not COVID. I think, as you mentioned, Marc, the reality is that being a online remote training company, we're well placed in this COVID time. And so whilst your pitch to an investor or the process you follow doesn't change in terms of research your investor, understand the thesis that they typically invest along, show how you position your business in terms of their way of thinking. So Rob has given away essentially the keys to the safe in his detailed description and really speaking to those needs directly, which we did fairly well. I think what helped us in this particular timing was the fact that we were able to double down on narrative around the macro themes that supported our initial hypothesis as a business. And so it was a function of one, after that, using that to lock down our anchor investor in the round, and then thereafter think through how best you want to bring it together. And so it was essentially thinking about it from first engagement to the end, probably a 3.5 month journey to get things down. And we're glad to have Endeavor Catalyst as an investor in our business in this particular round as well. But the key thing for us was around having the right partners and making sure that we were making use of the current context being COVID and really applying our minds around how best is what we do as an organization or business fit the current narrative or the current sphere of things.
What needed to change from the way you potentially presented to, what questions came up that were different from the questions that maybe you had in January or February?
Yeah, I think it was interesting. There were lots of questions around business resilience, because I think you can have a product that is able to scale, but the question is, can your team scale? Can your team work remotely effectively? Can you bring on relevant content partners during this time? And so it was more so around saying, look, are we as an organization ready for the new future working one over and above our actual product and our value offering? So that was a very key one in that particular way. But in the same vein, on the other side, some investors asked us, are you ready for the scale? Like, are you as an organization ready to capture the market opportunity that's in front of you? So if you don't have people, customer support members in the business, can you support the scale that you're actually extrapolating given the fact that you'll be hiring during COVID? And so it went both ways, from a risk to the business, but also the upside risk, and being able to let you have one, thought through, and two, position your business for scale if that's what you're solving for.
What if you have to sort of try and break it down in a few different bullet points? Would be the questions around scale that they were looking at.
Yeah.
When they started interrogating one layer down, what did that mean?
Yeah. And it's interesting. Different investors, depending on what they value, have different focuses. So the first one most organizations will ask, especially when you're an entrepreneur or founder who's still operating a business, is, do you have the ability to scale your team? And that means, do you have the ability to hire and attract people who are smarter than yourselves, experienced executives, and actually bring them into an organization, as opposed to, for example, micromanaging and have a fiefdom? And so it's almost that maturity of an individual, which is often the starting point, because many founders or many businesses in our journeys are typically founder run. So that's a big one there as well. When you click a level down, it comes down to the operations of the business. And that's more so around like basic things like, your team structure. Even sometimes we've had certain investors actually say, like, look, let's come into your back and understand your code. How's it structured? Can you actually handle the scale? Because the customer can say, yes, I had a good or bad experience, but actually what powers that is a different thing altogether. And where they have the skills to address that was, again, particularly telling. And then the other one for scale is, do you have a deep understanding of where the scale is going to come from? So I can tell you that there are X billion people and the market's this billion wide. But the question is, do I have a nuanced understanding of how I'm going to access that market, put together a proposition that speaks to them from where I am today? Because the reality is, as you grow and scale, you have different needs. And so it's something which, so we did a program called Y Combinator, and program used to say, look, you'd rather have 1,000 people that love your product than 1,000 people that like it, or like 1,000 that love it than 10,000 that like it. And the key thing there comes down to being able to tell your proposition to grow the actual target market of your value proposition. And so at that particular level, it's the scale question comes, how do you go from where you are now to where you want to be in terms of the go-to market?
How many customers now do you have that love your product?
According to our NPS score, so let me give you the quantum, the percentage. So we have just under 2,000 customers. And I would say our NPS scores are fairly high. So most of them love us. If you don't love us, please put my DMs and tell me who was.
Great. Before we just move on, I wanted to get to Louise, but you mentioned Y Combinator, and a big theme in for South African startups, especially those wanting to enter into global markets, which you guys have done, is how do you get there? So what I wanted just to get a sense from you is how important was a program like Y Combinator? What other sort of advice, especially in this time now, would you have to entrepreneurs, who need to open up and want to open up to global markets?
Yeah, and I think it touches on a few things. And thank you for the question. I think Y Combinator, so essentially it's an incubator which takes place in Silicon Valley, one of the preeminent ones in the tech ecosystem. So they gave birth to the likes of Airbnb, Dropbox, Stripe, and a few others, and very powerful network at that level. But then again, I would argue that not all businesses are suited for Y Combinator, but I guess if you're looking at the venture capital journey, you probably are better suited given your ambitions and your growth pathway. I think for us, thinking through what made us relevant and useful is to play to your strengths. I think something as an emerging market business, I think as Rob said, we're a lot more cost conscious compared to, for example, some of our more US compatriots. And so the reality is you can build a proposition whereby you are essentially, let's say in South Africa, paying people in rands and earning dollars somewhere else, so a stronger currency. But the key thing for the Y Combinator journey and I guess thinking through even the benefit at that particular level was for us, it was a platform to enter the US because so I'm South African, my co-founder is Australian, we were in the UK, and the reality is we had no real access in the US. And we knew we could go and try to spend some money running around there, but we felt that Y Combinator as an ecosystem had some credibility around it, particularly as and just for context for us, so we did Y Combinator in 2015, but the first real office I opened up in the US, or we opened up in the US, must have been only 2 years thereafter. And for the first years, even after Y Combinator, we sold remotely into the US from other geographies like South Africa, like Australia. And so I think for entrepreneurs looking to go global, something which I will say, and Rob can probably speak to this, but if you are looking at entering the US, we find that US investors value US revenue or dollars from US clients more than South African clients. And so at that level, it's trying to think, how do you build that? But you can definitely build out businesses remotely from where you are and sell into the US. All the tools are there. I mean, the number of phenomenal entrepreneurs, I think of a few in South Africa, names and faces, and others who have their dev teams, for example, in Cape Town, but actually have their go-to markets in the US. And it's a light cost way of you putting your foot in the market. Because the reality is, what I do find is, as African VC ecosystem, even entrepreneurs, we have the ability to compete internationally, but we often find ourselves to be apologetic when we approach those particular markets. I think something to be said, if you read, let's say, Startup Nation around Israel and what they did there, it's about being more daring in putting yourselves in those situations because we build really good tech locally. And so Y Combinator gave us both that brand name and that edge, but ultimately it came down to more delivery on the back end and sales. Yeah.
And I think from my perspective, I think this is a fantastic time for South African companies to emphasize the value of the product that's being developed here, the cost base here, and now the ability to sell and penetrate globally from in a remote sort of environment. And I think the world has changed, I think, forever. What are your thoughts on that, Louise? Or maybe first give us a intro to Naspers Foundry, and then it'd be interesting to hear your voice on your opinion on that.
So Naspers Foundry, we're essentially a 1.4 billion rand South African focused it's not really a fund, it's an allocation of capital. You know, that quantity can go up or down depending on the opportunities we see, but really we're looking to invest in local South African tech companies. And our motivation is to stimulate the liquidity in the local market. So we've got a very broad sector focus. You know, we're not specifically sector led. We're looking more at companies that have got global potential. We're really looking to help companies expand internationally, and we look to get under the hood of the business model, really understand where the power in the supply chain is. You know, as Melvyn spoke about, the ability to scale and the ability to protect one's margins as one does do that. So as a result, we've looked at a broad number of sectors. You know, we're seeing some interesting opportunities in education. Food is a big sector for Naspers globally, so we're looking at the food supply chain locally. Fintech, obviously quite an exciting sector here. So really quite impressed by the quality of targets that we're seeing locally, and we've got a great pipeline. And we continue to invest through the COVID environments. Obviously, uncertainty has increased, but for some companies that's been, you know, the digitization trend we're seeing has been a good thing. So very much active at the moment.
How many deals have you done now? How large is the pipeline?
Yeah, so we've closed 2 investments. We invested in a company called Sweep South, and we recently closed a round with Aerobotics to put 100 million rand into their business. So very excited about that and the prospects we're seeing there. I mean, Aerobotics, you know, we like the real global potential of the asset. They've already been in the US, showing some strong traction with the insurance market there. Great team, and quite a strong competitive position that we liked in the AI agri-tech sector they're playing. So, you know, we expect big things from them.
No pressure, Benji.
Yeah. As our pipeline, I mean, it's full. Hopefully a couple of investments to be announced in, you know, the coming months, but things change all the time. So I can't really put a number to that, but we're busy. So
when companies are coming to pitch now and they're going through the process, what, you know, how are you evaluating them? How are you, you know, what are the things for that, you know, they should be focused on, that,
yeah,
items that you might be looking at a little bit more carefully now than you were before?
Yeah. So global potential is something, you know, we really like. While we're going to make potentially smaller investments here locally, we would love to grow these businesses into something really substantial. So the ability to be able to have a globally competitive product that can go to other markets. And it doesn't necessarily have to be the US. I mean, we've got a great footprint in India, you know, expand throughout Africa, but companies that can sort of expand beyond the South African market is something that we really look for. I mean, it's not, we are looking at specific South African companies, but it's ideally global potential is important to us. Strong competitive position. And we think that's, you know, that positions you to attract better talents. You know, it has a positive effect just on being able to scale and grow. So competitive position is important. But for me personally, the most important thing is, you know, as you grow, how you can protect your margins. Are you going to be a price taker, or are you going to be able to, you know, continue to extract value from the product or the service that you're offering? And that's, you know, it's not the same. In each sector, you have different players in the supply chain who've got different power in the supply chain. Across sectors, you know, some sectors are stronger than others, but it's, you know, at Naspers, we love marketplaces because of that power in the supply chain you have. Network effects, to the extent that any network effects, that's very positive for us. Not easy to come by, I must say. A lot of people say they've got network effects, but it's not really network effects. But to the extent there are network effects, you know, what we like about that is the virtual cycle. As you get bigger, you grow faster. It's sort of a positively reinforcing cycle, which we think is pretty positive. And sector-wise, I mean, it's very broad. You know, at Naspers, we invest in the food, classifieds, fintech, but in Foundry, we look, you know, we're looking much broader than that. Education's interesting, looking at some health tech opportunities. So we're not sector limited. Obviously, a very strong tech focus, however, tech only.
Benji, going on to Benji. Thanks, Louise. Do you want to tell us about the Aerobotics raise and a little bit about Aerobotics and the raise from your point of view? How did it go? Advice for other founders out there?
You can't give an honest answer because I'm in the room.
Now we switched off audio for all Naspers and employees and Louise as well.
Cool. Yeah, thanks, Marc. So Aerobotics is an ag tech company. I think Louise gave a bit of an intro there, so thanks for that. But essentially, focused on building solutions for farmers to help with two main value propositions. One is early problem detection through pest and disease management. And another product that we've been building out is that of yield estimation, or the ability to kind of predict and manage your yield more effectively. And we do this mainly through aerial imagery, largely from drone data, and really focus on building the solutions to help farmers action this information in making decisions around interventions that they can take in the field in the right time, or in the right place and at the right time. And yeah, we've been going for just over 5 years. We've, I mean, starting off, we used to build all our own hardware. We used to build drones, we used to build sensors, and write all of the software. And over time, I think I've got a bit more business sense and have watched the space kind of grow a bit and the hardware become commoditized and really focused more on the software and analytics side of things. We focus quite niche on specific crops, mainly high value crops, citrus being one of them, and really try to get as deep as we can into that specific crop in that sector. And Louise alluded to insurance being one of the angles that we're working with. We essentially looking up and down the supply chain to see which other players within that vertical can extract value from this product, and who can we use as help in distributing this to growers. And yeah, the company is headquartered here in Cape Town. We build all of our product locally, kind of work very closely with local farmers too. But have really started more aggressively starting to sell in other markets, particularly the US, over the last couple of years. Also operational in markets like Australia and Portugal, and have grown a distribution network through channel partners in other countries around the world. I mean, in terms of the raise, yeah, I think it's been a positive process overall. Obviously feeling extremely fortunate and grateful to have got it over the line in these times. I mean, we had a couple kind of hiccups and frights along the way, just with what's been happening in kind of the global economy as a whole. But yeah, I think overall we're really fortunate not to have been impacted too much. I think we can talk a bit more about the specific impact of COVID on the raise, but very, very fortunate to have the deal. The plans now with the cash are to really consolidate and help grow the business. We want to capture this insurance opportunity in the US, along with some other opportunities globally. We've spent years kind of developing the product, building the brand, proving the market out, and really want to use this to capitalize on that opportunity.
Louise, going back to you, what was it about Aerobotics? Other than, I mean, good to touch on the business model, but other than, what were the things that you were evaluating that you can obviously share that took you over the line to invest, which by South African standards is a big amount. It'd be great to sort of get your sort of insights around that.
Yeah, with pleasure. There are a number of different angles. I think the main themes were the actual product, the competitive positioning of this product, not only relative to the other players in the market, but also the other current alternatives that growers and insurance have. The Aerobotics team talked about showing their products to other farmers and insurance companies, and just, the light going on about what they can actually potentially do compared to what they used to do without the technology. We thought was pretty exciting. So very strong competitive position. And the fact that they had already entered the US and had some good traction really underscored the global potential of the opportunity. It's one thing to sit in South Africa and say, we want to globalize, but to actually do it is not that straightforward. So to have a team that were actually in the process and were successfully implementing gave us a lot of confidence. And the team. I mean, at Foundry, we really are founder-led. We really like the team. We like their pedigree, their tech focus, their ambition. Rob mentioned the word agility. Agility is a key word for us. You know, the fact that they could show that they could evolve from doing the hardware to focusing on the software. You need to be able to adapt. You can't think the business you have today is going to be the same business even in 12 months' time. Things evolve rapidly, and teams need to be able to recognize that and move with the times rather than get stuck in the way they thought they were going to do it. So that's critical to us. And the opportunity, I mean, we need big markets. If the company's going to be significant, it needs to have big opportunity. And we think agri-tech globally, the high value product crops rather like citrus are huge markets that, you know, give a good opportunity to go after.
Benji, what if anything have you guys as a company had to change in terms of the way you think about the next 12 months? You know, whether it be your strategy, you know, what you're focusing on, execution.
Yeah, I guess there's been a couple changes in general. One is our mindset kind of overall has shifted a bit from sort of this growth at all costs and very aggressive mindset to one of more sustainability. And obviously in raising this investment, we've got an amazing opportunity here. And just the way that we deploy that capital and the efficiency that we kind of deploy it with is something that's become very important. I mean, it's obviously something that in principle is always important. Just in the current times, it's we've given it significantly more thought. We've really dug down into things like unit economics, making sure, I mean, Louise spoke about margins a couple of times. It's something that we've really started focusing on a lot more over the last few months, and really understanding kind of that we're investing in the right places, and that this is helping fund the rest of the growth of the business overall. I guess another point is just really understanding how the current situation impacts our business in general. We're quite fortunate in that the industry that we're in is protected somewhat. I mean, agriculture is obviously an essential sector, as well as the technology that we're building, if anything, is in the right direction. I mean, the concept of remote sensing and assessing crop without needing to get boots on the ground is obviously quite an attractive kind of solution. What's changed has been in the very short term, really understanding how this impacts our business and building a framework for doing that. And I mean, we've employed a technique recently, which was something that David Frankel actually posted on Twitter about a couple of weeks ago that we found very useful, which was basically a modified version of the 5 whys, and just an interrogative technique to really understand how the situation impacts a business. And in this case, it's been more of the 5 whos. And really understanding, I mean, outside of the sector being protected, etc., there is an impact on the business, and digging up the supply chain from the customers to operations in those markets to other actors in the supply chain, how this impacts our business. I think based off all of that analysis, there have been some changes we've made. There's certain aspects on the product development side of things that we've accelerated because of what's happening. I mean, a specific example is we use drones mainly as our data collection mechanism, where there's still an operational component to that. I mean, you send a pilot out to a farm, he has to travel there, put the drone down, collect the data, etc. And obviously there's limitations in the current environment to how well you can do that. So, I mean, we've been looking at different mechanisms for collecting data there. It's always been on the roadmap, things like satellite data, aeroplane imagery, etc. And we've just accelerated that development given the potential upside that it would have and the ability to help scale. Also, just the sales process has been quite an interesting change. I mean, we're selling to farmers mainly. I think a couple of months ago, if you kind of try to sell a product to a farmer over a Zoom call, they'd sort of laugh at you. But this is something that we've really had to refine and get to grips with, and get the market to grips with it too. So there's been a lot of innovation that we've been doing on that side. We found a lot of our customers are corporates, the insurance companies in the US being an example. If anything, the situation has actually accelerated things on that side too. I mean, there's sales processes that we were going through that were kind of likely to convert at some point, but the need on their side to really innovate and make the most of this has also accelerated. So I think we've reaped the benefit on that side too. And I guess in general, there's obviously strategic work on the operational and internal side of things in changing the way we think about our team, how we attract talent. Despite having a distributed team in different geographies around the world, we haven't historically really been a remote friendly company, and all of the development gets done in the office here in Cape Town. And I think very much for the best for us, it's really been a forcing function to change the way we work and how we think about these things. And there've been quite a lot of changes we've made strategically as a result.
Fantastic. Rob, how do you think of supporting African countries that want to scale into other markets like the US? Be nice to touch on that. Obviously, Endeavour's big focus is really around supporting entrepreneurs that can scale globally. We do that by pairing. We're nice to chat with and get your feedback on that as well, Melvyn, and your experience there. But before we get there, Rob, what's your experience with that, and what local entrepreneurs need to be able to sort of enter into new markets, especially in this time?
Yeah, well, I mean, the first thing I'd say, Marc, is there's a tremendous opportunity in the cities a little bit further north of Table Mountain, in parallel to the US. And I think for us, the opportunity set that we've been really excited about is innovation actually at a city level on the African continent. Yes, there is a huge opportunity to scale to the US and Europe and many other markets. But we tend to find that where there is technology deployed to solve a scale problem in a city like Lagos of 20 million people, or Cairo, similar size, or other African cities that have a greater degree of interconnectedness, that is really interesting. We find that African corporates are largely ignored as a customer and face similar challenges and needs despite regulatory environment challenges and sometimes differences in reaching their customers. So that's really been our focus, and we've absolutely seen that talent, human capital is our greatest asset on the continent, and we've seen that talent is absolutely evenly distributed across these fast-growing technology ecosystems. I'd say we've typically focused on companies that tend to be either platforms or enable legacy technologies. If you have a product that allows an industry like the banking industry to work at 60 to 80% cost savings, that to us is very, very interesting. And so there's still a lot to be done there, before looking at developed markets. I think we're obviously blown away by sort of the dev skills and the technical talent in SA and many other African countries. But for us, it's quite a simple sort of set of things that need to line up, and we sort of try and drop it into 5 buckets. The first is what we call proof of concept, which tends to cover technology, IP, product market fit, sustainable differentiation, those essential things that you can't exist without. We then spend a lot of time on people, and really there it's about balanced teams. We sort of like to say that you need a hacker, hustler, and a visionary, and a lot of other things, but look for sort of the ability to balance out skill sets and for a lot of skin in the game. And then I think what we spend the most time on is what we call determinants of value, which is unit economics, and it's anticipating how your cost structure and pricing might change. We then focus on whether that can back out to the returns that we require for our investors, because although we have an impact mandate, we are a returns first venture fund. And then we tie it back to the mission. the company, and if it's aligned with our mission of what we think is an important part of developing the continent as well. So, your original question was what makes for great scale companies that are able to grow, I think you said to the US, but I'm going to say to a second market. And
large, to an expanded market, I would say,
Yeah, and I think it's as simple as really truly understanding your customer. In the case of AppZone in our portfolio, yes, they have products and services that 12 of the 18 large Nigerian banks use and 350 microfinance institutions use, but there is a ton of inbound inquiry from similar customers and now customers in 7 other African markets, because the problem is the same, and how you deploy the solution to find that customer is really what matters. Look, it's very difficult. I don't want to pretend it's not. A second market doesn't look like a first market. But if you understand what's different and what's the same about your customer, that's sort of where I think 80% of the time gets spent.
Melvyn, how many, maybe you want to add to that, how many markets are you in now? What's that path been like for you? And then Louise, afterwards.
And so just for a high level, so currently I have a physical presence or teams or offices in 8 countries, but service clients in north of about just over 25 now, 27. And I guess there are 2 things based on even your question on what Rob said, which I probably want to double click on, and then also probably give a shout out to Endeavor for their role on that journey. But I find that often as businesses, we're very keen to, especially as entrepreneurs, we take delight in closing the next client or the next opportunity. But especially in our space, which is a software as a service business, your biggest and your cheapest cost of growing revenue is actually, I think to Rob's point, deepening the value you paid for your current clients. I think the ability to upsell in your current clients versus trying to capture a new client, even a new market, is something which is often understated. And what we've seen when we began the business, we started in 2015, we won the award for the best learning platform in the world. And then we were just like a learning management system. Think of us like a bookshelf. What we are today is we provide the bookshelf as well as the book. So we actually offer the content on that. And just the price point that we offer our product at now is probably more than 90% of our revenue. Yet we're speaking to the same stakeholder in an organization, the L&D manager, the HR manager, and so on. Yet you were leaving so much on the table in terms of value we could create for them. And so just by us deepening our value proposition, we were able to grow to a point where even though we've grown to many markets, in our current accounts, we're able to capture value. And so I think it's also thinking through, you're solving for the money. The money doesn't necessarily need to be next door. It can actually be where you currently are. And that's something to bear in mind as an entrepreneur when you think about falling in love with your problem that you're solving for the customer and asking yourself how best can you actually solve that problem for them and capture that value on the way there, which has been our insight as you built out Go One. I think also in parallel, our first employees, were fine family members and some of our classmates because we didn't have people in certain markets. And so after South Africa, one of the first sales team was a team out of Nigeria. Because I was like, Nigeria is, just for context, as a market education-wise, they love certification. If it's like if you didn't get a certificate, you actually do the course. And a very active education market. But I think the way in which one captures a market, enters a market, is also important. And I think very early on it was like, we'll hire a salesperson and they'll go forth and conquer. But there's lots of school fees in terms of understanding the market. Yes, right now. So as you scale to new operations, we opened up an office mid last year in the UK, opened up one in Dubai now. But in the same vein, whilst we have playbooks internally of what's worked for us in terms of what needs to be true for us to enter a market and how to scale there, there's certain nuances. And I think the way in which you enter there, either through reaching out to possible allies and partners is a big part of our growth these days. And I think to my Endeavor journey, where when we did the Endeavor process, and for those on the call who don't know, Endeavor typically, when you become an entrepreneur, you go through 2 phases, if you call it, of vetting. One locally, with some very influential business people in South Africa, which is a local selection panel, and then international selection panel. And we were very particular in choosing to do our international selection panel in Malaysia because we wanted to win a very large government contract there and wanted to set up a base there, which we did win, and we at the point trained about 200,000 people there a week. But it's about almost thinking through how you enter a market as opposed to just thinking that it will be business as usual. And I think there are some nuances there. And so for us, it was one, know what you're good at, but also don't be afraid to partner to achieve your success.
Yeah. One of the reasons why I think Endeavour is such a powerful organization, because they really managed to bring the network in the right location, directly to you. And really ultimately, the value of that network determines, as my father-in-law always says, the value of your network determines the value of your net worth. So, so thanks for that. Shout out to Endeavour. Louise, how do you, and Naspers, how do you think about entering new markets? I mean, Naspers itself is an incredible organization that's got presence in so many countries around the world.
Yeah, I think it's not a one size fits all. It's very dependent on, the business, the markets in which you're entering. I think both Rob and Melvyn gave, some good views on the opportunity, well, the potential, the way to think it through. For me, the one key thing is you've got to be globally competitive. I mean, it sounds obvious, but it's quite complicated and difficult to do. In this environment, particularly where borders are, you're more conscious of borders physically than ever, but virtually, I mean, they basically don't exist. We're all sitting here in a webinar, and it doesn't really matter in which country any of us are really sitting. So in order to be able to enter new markets, if you're doing it from a digital perspective, you need to be as good as anybody else anywhere in the world. And that's the thing to focus on. And if you are, then it's easier to do.
Some of the questions that are coming up, just looking at the Q&A, talking about, actually specifically addressed to you, Louise, how do you think about IP, when you invest in a South African business?
You mean where the IP sits?
In terms of, where the IP is located, offshoring, etc.
Yeah. So, I mean, it's critical for us that the IP is in the entity, or the entity has direct control over the IP into which we invest. We don't want to invest in an entity and the IP sits outside. That's fundamental, and often it isn't the case when we start looking at an organization. So it's, in order for us to invest, that needs to be rectified. Whether the IP sits within South Africa or offshore is really situation dependent. I don't think there's a one size fits all, but we need to be invested in an entity that controls the IP.
Yeah. Just take a slightly different tack now. We were chatting yesterday around just the issue of valuations now. And what definitely there's valuation pressure. And I think in the US, I think it's been slow to come. I've seen some very, very depressed valuations recently, more than half. And then a big question that you talked about yesterday was, the trade-off for a founder, between valuation and what the cap table ultimately looks like, depending on how much cash you're going to take now. So it'd be good to maybe hear your thoughts around that, and maybe we can share that as one of our last discussions. Yeah,
with pleasure. So I think it's a big dilemma for founders in any economic environment, and particularly now. The trade-off between the amount of capital you raise and the timing of raising that capital. Obviously, the more capital you raise, the bigger the impact on the dilution. But at the same time, you want to have a business that is well capitalized in order to weather the potential, whatever you might face in the next 12, 18, 2 years. So it's a trade-off. And I think particularly now, there's different ways to approach it. And Marc, as you alluded to, I think the type of investors you have in your cap table is probably one of the deciding factors. To the extent that you have angels that might be facing liquidity crises and similar to the early stage businesses, probably more higher risk if you're going to be starting to look to raise capital in a couple of months' time. So setting up your cap table with partners that can see you through, for me, I think is probably very important, particularly given the uncertainty that we're all facing, is the one point. And I think the other point is, and then think about potentially tranching your capital raises. So if you do have a cap table where you have partners that are able to follow as the need arises, then you would have the opportunity to take less capital now when there's more uncertainty around valuation. And you know, if you've got relationships with existing investors, they know your business, the conversation is a much shorter and easier question to raise further capital down the line instead of starting from fresh. So yeah, structure your cap table. And the other thing, everyone talks about depressed valuations, but we don't know, you know, in 3 months time, it could be worse. So, you know, if you back yourself and you believe your valuation now is lower than it should be, take less money. But if you believe, you know, you could be coming on hard times, probably take more money. But the quality of your partners, I think, is critical, particularly now.
Marc, just to add to that, because I think you know, Louise said something very important, and to generalize it, I think it's a great time to create alignment. And creating alignment means agreeing on what milestones are and agreeing that there's going to be uncertainty. And we've seen that to work very well with tranching, as well as, you know, I think convertible notes are, you know, back in force instead of price rounds because of the amount of uncertainty. If you can create a situation where you agree on a multiple of revenue that your business is worth and checkpoints when you might, you know, require capital and have that relationship with the capital provider, that creates trust and alignment. And if you're measuring sort of the data points along the way very discreetly, there are no surprises. So I think that's super important in this environment. Yeah.
And what sort of milestones are you talking about tranches based on certain milestones? If so, what sort of milestones are, you know, should entrepreneurs out there be thinking of?
Well, I mean, a lot of our businesses have strong enterprise customers and really interesting sort of pipelines of new enterprise customers, or to Melvyn's point, upsell opportunities that will require expanding teams. And so if you get to a point where an existing customer wants a lot more from you and you need to hire to fill that need, you should go fetch that capital. If you are still figuring out sort of product market fit, raising a lot of capital to do that with doesn't seem like a great idea. So the milestones that you know we've used, they are very tied to the business. They're very tied to, you know, the 3 or 4 key things that drive revenue. But I think in no scenario do we think it's realistic to have, you know, less than 12 months runway as we go into this environment. And that has required top-up rounds, even in our portfolio, at valuations that look pretty different to 6 months ago. But at the end of the day, even in this tough market, I still think that, you know, capital is the commodity and alignment and partners is what's crucial. And good businesses will raise funding rounds. It's something that we're not seeing them struggle with. There've been a lot of notable closed rounds, you know, in this time. Yeah.
What I think is absolutely, agree with that, and what I think is absolutely critical now more than ever is this alignment also around values. So really understanding, you know, as an entrepreneur, you may or may not have the choice right now, but if you do have the choice, to be able to understand the values and the longevity of your institutional partner. You know, will they be around? If the person that's investing is not around, you know, what are the values of that organization to support you? And I was very fortunate when I was at SoftBank pre you know, the $100 billion fund, you know, over 10 years ago, and there was actually a South African, Ron Fisher, who's been at SoftBank since the beginning. He's number 2 basically at SoftBank still, and I mean, he was the most incredible person. You know, he would, you know, companies probably didn't deserve to take the capital, but he would help. He would drip feed, you know, even when they probably should have closed down. And that was in 2008, 2009, 2010. And eventually, some of those companies came back, and we managed to help salvage them, you know, sell them, find ways to get the founders to make a little bit of money out of companies that could easily have closed down. So to me, that's a critical point. Louise, you have something to add?
I mean, I don't know if this is particularly on point, but just to give sort of a little bit of confidence to the founders out there. I mean, at Naspers, we made our 10-cent investment in 2001, which was, you know, just after the dot-com bubble crash. And we did our Lateral investment in 2008, which was, you know, during the financial crisis. So there are definitely good deals to be had out there. Don't be despondent. And yeah, good luck.
So what's, if we've got like 1 or 2 minutes to wrap up, I mean, maybe I can ask each one of you, what would be your last little bit of advice to founders, founding teams, raising their next capital round? What would be 1 or 2 of the most important pieces of advice that you would give them? Melvyn, do you want to, I'll ask, let's go Melvyn, Rob, Benji, Louise.
Yeah, I guess looking like a schoolboy in my blazer today while everyone else was out in the sun. I think
We know
the key advice is,
you're not wearing shoes, so it's fine.
I think the key thing is to do your homework. I think it's surprising how few of us as entrepreneurs don't take time to actually do some deep DD and understanding of our investors before we approach them, understanding what they care about, who they invest in, what kind of personalities their partners have in the business, and really do your work. So by the time you approach them, you know everything you need to know. And all you're doing is just trying to play the game and build out that relationship. And I think that's probably my best advice in terms of raising capital now, but more generally as well.
I want to say it's a great time to start a company or scale a company, but make your conviction measurable using data points. It's as simple as, what are the 3 to 5, critical success factors for your business to succeed, and to measure that you truly, do have a competitive advantage, and be very honest with yourself on a sensible timeline. That it's playing out that way. We use, monthly KPIs, and they do change, but have data to back up your conviction.
Before we go to the next, it feels like it's just, someone pointed out the numbers of participants have actually gone up in the last couple of minutes. Maybe someone said something interesting, but can you mention, Rob, a company, or where, just to make it a bit more real, some of the KPIs that tangible KPIs that are critical to, that you are measuring?
Yeah, I think for investors, there's this misperception that making the investment is the hardest part. It's really not. We operate in an environment where, typically venture backs 1% of what it sees or less. So yes, there is, the search process is intricate, and everyone's got their own methodology. I think for us, a big part of that is, we work with founders to define, and all credit to my colleague Ochua, who runs our Lagos presence, because she's really designed our company building playbook here. But we work with founders before we write the check, and before we close around, to define what the 100-day plan is post investment. It's very important that the KPIs matter to founders, because there's very little value in just being a data provision service to your investors. But it's really about unpacking your revenue model and understanding what you do and don't control, and then focusing. You asked for a credible example. In one of our fintech businesses, there is a huge opportunity for 2 new products to scale the revenue by more than 2x, and it's the same customer base that use their existing products, but we're hyper focused on how to drive engagement with the blockchain clearing product that they've released. And so the KPIs that are really important right now are converting those leads and not sacrificing pricing on the new product. And that matters to the CEO of the company every day that he wakes up. So it's important that it's driven by founders, not by VCs. I think the other way to go about it is just to think about, what could kill your business. And I think it's Amazon that came up with the idea of a pre-mortem. It's like, if the business died, what would have killed it? And that kind of thinking also goes a lot into our KPI monitoring.
Great.
Yeah, I'll jump in. I think there's obviously some asymmetry here with the likes of Rob and Louise. I mean, we've only been through so many rounds up until now, fortunately. But yeah, I think just to Rob's point, also just being sort of data driven and building the ability to track things and track the right metrics and communicate that effectively to investors along the way. I mean, just internally, something we found super useful through this process is just building a framework for making decisions. I think, Marc, it's something you've helped us with personally in really being principled in how you make decisions as a company, and that obviously relates to the fundraising side of things too. I think just kind of a last point is it's very easy in this time to make short-term based decisions, and I think as a founder it's super important to remember your reason for being and your kind of reason for starting off in the first place, and finding partners that back that, and making the right long-term decisions, opposed to just sacrificing for the case of capital.
Fantastic. Thanks, Benji. Louise, we'll finish off with you.
Sure. I think sort of some advice might be, particularly now, for founders to be realistic. You know, as investors, when you're looking to give your capital for people to grow and build value, you want someone or a team rather, that's realistic about what's coming. You know, it's one thing to fall in love with your product and think and obviously as part of the sales cycle, you're really trying to sell the solution and the upside. But it's important for us to also understand that you are conscious and are mindful of the risks and the potential downside. And particularly now, so to the extent that we can have confidence that you've thought about it, you've planned for it, you understand what your levers are that you can pull to the extent that it does materialize, you understand your dependencies on other businesses. I mean, it's a macroeconomic pressure that we're feeling at the moment. So while your business might be well positioned, there might be other businesses on which it depends, which aren't going to fare so well. So to the extent that you've thought about it and built it into your thinking, that builds confidence for investors. And I think that's important to demonstrate, as well as the upside that you're selling when you come and pitch to us.
Fantastic. Well, thanks to our panel. Thanks, Louise, Benji, Rob, Melvyn, for joining. I've learned a lot. I hope everyone else has as well. Yeah, thank you very much. It's a tough time for entrepreneurs at the moment, for teams, but at the same time, I think more and more we're starting to see a lot of opportunity as well too. So, keep with it. If anyone needs advice, we're here. Endeavour's here to support the community. So please be in touch. Thanks very much. Cheers.